Good afternoon and welcome to HYCM's webinar with myself, Giles Coughlin, and the FX Week Ahead live market analysis. I'm just going to take a moment to wish you all a happy new year. If someone could just let me know that you could hear me on the question panel, that would be great. What is the meaning for hand? I think, yeah, Abdul, I think the hand means you want to ask a question, but if you just, either put it in the chat or the question panel, I can look at that. So I assume that you're hearing me okay and I'm coming through. I'm just taking a while to get back in the swing of things, having been away for my Christmas break. And Happy New Year to you all. It's good to be back and nice to have you on board. Salvatore, good to have you back again. Peter, hi. Ali, Abdul, that's great to have you guys on board and looking forward to taking you ahead for the next week. And we've started the week with a real bang, as it were. Forgive the inadvertent pun there. But what I want to just check as folks are still coming in is that everyone's understanding that as we're looking at the FX week ahead, what this workshop is not about, this webinar is not about, it's not about trading signals. Instead, it's about how to understand the market for yourself. So, a big success for me would be if after attending these webinars for a number of months, eventually you get to the stage where you don't need someone like me and you're just able to do your own analysis and work out your own decisions. So you're going to be looking over my shoulder to see how I trade, and by looking over a professional shoulder, the idea is that you see the thinking process that I use to go through the markets, because the markets move for a reason, and understanding what those reasons are is a critical first step in making your own choices with confidence. So without further ado, we will get into the event for the week. Don't forget there's a question panel there. You found it, Abdul, and don't forget the chat panel as well. So if you've got any questions as we're going along, feel free to ask them. And don't forget, tomorrow at 1 o'clock GMT time, we have the workshop where if you've got any trading ideas, please feel free to run them by me, and I'm very happy to comment on what I'd be expecting on those currency pairs that you suggest to me. That's a really good, helpful learning tool. If you can, get some feedback for your trading ideas, it can just help you develop that confidence, particularly at first, if you're thinking down the right lines. So don't forget that option is there. For tomorrow, this webinar is primarily a week ahead, looking what's happening, trying to understand the major scheduled events as well as the major unscheduled events. And we do have a major unscheduled event, which we will use to start the week. And this has been when US President Trump directed the killing of the top Iranian general last week, Qasem Soleimani, in a drone attack at Baghdad airport during last week. Now, this happened early Friday morning. It's been impossible to miss this event. It's been all over major news wires, and it's a very serious situation. Now, what's expected from this strike is an Iranian retaliation. So at the moment, the market is in a state of heightened risk-off status. In other words, the risk-off sentiment is seen. Risk-off sentiment, for those of you who follow the workshops and the webinars regularly, know that that's gold strength, Japanese yen, Swiss franc strength, as well as Australian dollar, New Zealand dollar weakness, and Canadian dollar weakness usually, although there's a slight exception with oil being bid, and I'll get to that later. But we're seeing some of those moves going in. Now, President Trump has warned that if Iran do retaliate, he's going to target 52 Iranian sites, striking very fast and very hard. Iran has said this morning that they're retreating from the nuclear deal. I think it maybe was last night, either early this morning or last night, they retreated from the nuclear deal, saying it won't comply with any restrictions on the amount of uranium enriched. And then US President Trump has threatened a major retaliation, perhaps in a disproportionate manner, should Iran retaliate. So in other words, Yeah, okay, Abdul, we'll get onto oil and we'll look at that. I've got some information on oil to share just to show you what's going on with the oil and the situation with oil. Now, okay, so this is the situation we're currently at. We've got US President Trump threatening a major retaliation. So the big picture here is we're at a crossroads. What is Iran going to do next? If Iran strike the US says we're going to strike back even harder, essentially. So any move from Iran now will be seen as further moving the market into a risk off mood. Okay. So at the moment we are in a risk off mood. But a lot of this bad news has been priced in. We've seen strong bids in gold and we've seen strong bids in oil. Now the reason we've seen strong bids in oil is there's been concerns that if there is Iranian conflict in the Middle East, it will drag in Iraq and maybe Saudi Arabia will get dragged into it, and supply issues will hurt the oil market. That's why we're seeing oil bid on a risk-off mood. Normally, in a risk-off mood, we would see oil being sold, but that's why we're seeing oil being bid at the moment on the anticipation that should the conflict escalate, oil is going to be, the supply is going to be limited. So that's the big picture that we're seeing. So this is the major story at the moment is this unscheduled event. So we can't understand what the market is doing now, and we're not going to understand what the market's going to be doing through this week if we haven't understood this key geopolitical event. So we've got the big picture. We know what we're looking for. Another key event to look out for is that there is some talk about the US administration voting on limiting President Trump's response to the Iranian retaliation. So a lot of political moves are taking place in Europe, NATO, UK, and now the US administration to try to de-escalate the situation. One of my members of my family, my daughter, was showing me some Snapchat, posts that have been shared, or Instagram posts that have been shared on her channel, saying this is it, it's World War III, and people were getting very, very upset, understandably. However, this event is not expected to trigger World War III at the moment, and so of course the political players around the world are just trying to, de-escalate the problem. So that's what we've got. We've got major players trying to de-escalate. Iran itself has got to think very carefully before retaliating, because President Trump is an atypical president. He tends to operate impetuously, in the moment, and unconventionally. So that makes it unpredictable and potentially dangerous. So Iran, they will have to think very carefully. So that's where we're at the moment. Now, let's have a look at what's been going on. So let's look at these gold bids. Now, gold has been bid. Let me just drag out the gold chart for us. Right. Okay, we've seen these strong gold bids. Okay, this is the daily chart. Now, just looking at the chart here, I was looking at the gold chart, end of December, because of the strong seasonal demand for gold. Now, the reason there's strong seasonal demand for gold is as the Chinese New Year approaches, demand for gold increases. And for the last 6 years in a row, and this year looks no different. In January, gold has been bid, right? So as a result of these gold seasonal demands and safe haven demands, we're seeing strong bids in gold. Okay. Now you can see here. Let's look at the 4-hour chart. You can see here on Friday. When was Friday? So here was Friday. That's the 5th. So 3rd. That was it. This was the initial bids on Friday of last week. Okay, the 3rd of January. That's when the drone strike happened, and we saw gold bid from 1530 odd up to 1550 odd on the day, and then today peaking at 1585, just hitting that resistance, that pivot point, R2 resistant point. Okay, so that's where we're at. Now, what I'm anticipating is, as long as this sentiment remains, I'm anticipating further gold buyers. Now, the one area that I'm potentially looking at is this 1550 region here. You see that 1550 and the R1 region. So if sentiment remains the same, I'd be expecting gold buyers to re-enter the market here. Okay, that's what I'm expecting. Now, personally, I was long from 1480 odd. I was around 1480 something, and I took profit on my longs around 1572, I think it was, just in that pivot point, just because, you know, that was it for me. I didn't want to maintain any more risk, and so I'm taking my longs. But I will reconsider entries. I'm expecting buyers at this 1550 level. Now, as long as sentiment remains the same. So what I need to see is this heightened sentiment. If the sentiment changes, say US and Iran look at making peace, that somehow out of this tragic situation and the sad escalation, if there's a de-escalation and a move towards more peaceful relations, then I would expect some of those safe haven gold bids to fall. But I'm still expecting seasonal demand. So, you know, potentially I'm looking at, if sentiment remains the same, I'm expecting gold buyers at 1550. But if sentiment shifts, I would still expect gold buyers coming in at 1500 and 1480. So that's what I'm expecting on the gold chart. So that's, you know, one thing to keep a careful lookout. Okay. Now we've seen Japanese yen and the Swiss franc bid on safe haven demand. So again, let's have a quick look here. So let's look at Australian dollar, Japanese yen. So we're seeing, you know, strong yen, weak Australian dollar. That's typically what we expect. So again, I would anticipate, as long as the sentiment remains the same, I'd anticipate sellers at 75.50 odd and 76 the level. Okay, they're the two places I would expect sellers, as long as sentiment remains the same. Now, Abdul, we're going to look at oil, because oil is interesting. Now, I again was long oil from the Friday retrace. So all I did here on oil was very simple. This was the big move on the Friday. I just drew a fib retracement here. I entered as price moved down to this 50%, 618% region. Can't remember exactly my entry. It was around here. Okay, and I got a good fill in at 62 something. And then on Friday, I just moved my stops to break even over the weekend, and price spiked up, and I took profit this morning. However, this is what people, I'll tell you what people are saying about oil, Abdul. What people are saying is that the oil market's quite well placed to absorb this strain. If you remember the Saudi Arabian drone strike, remember when there was that drone strike in Saudi Arabia and price really spiked up? Where was it? Yeah, here it was. So price spiked up and then drifted back down. Okay. What people are thinking, you know, with that drone strike, which impacted one of the world's largest oil fields, okay, the response was short-lived. So the desks that I've been reading have not been expecting gold to remain bid, oil to remain bid. I think JP Morgan, UBS, what a lot of market players are expecting is this to be fairly well absorbed. So for me, I just wanted to take the longs that I had, and then I'm flat on oil. But having said that, still looking at the oil chart, like for today, I'd still be looking potentially, I would still expect buyers, you know, down here at the 62.50 region and the 61 region. So I would still expect buyers from these levels. But, you know, the question you've got to ask yourself, Abdul, is has supply been restricted yet? And the answer is no. Okay, there's no major supply. So what would further add to oil bids would be something like Saudi Arabia gets drawn into the conflict, or some Iraqi oil fields, or the Straits of Hormuz gets blocked, something like that that impacts supply. But for now, it's wait and see. Now, obviously, if Iran do strike back, then I would expect oil buyers at market. But for now, I'm not chasing this oil market, and I'm cautious about further longs from here, because a lot of market participants think that there's not a lot that's actually going to drive oil prices necessarily further. Now, obviously, anything can happen, but I'm just telling you, Abdul, that's what I'm reading from the analysis that I've been looking at. And for me, I took my oil longs on a pullback and took it off of these highs. So here's just a little trick for you to show you what to do when you get a real unexpected event. Okay, so when you get an unexpected event like this, okay, the huge event, the US sends a drone attack, and you've missed the move. Say you come to your desk and price is up here, 64, and you're thinking, oh, I've missed this whole move. You don't want to buy at those highs, okay? Unless it's a huge event, you don't want to get sucked into that. Instead, just draw a Fibonacci retracement on the move, and this is exactly what I did. And I did a Fibonacci retracement on the move, put it up to the recent high, and then moved at 618. And I'll tell you where I got in. I'll just have a look at here we go. Just have a look at I closed it today. Yeah, I got it 62.33. So I was here 62.33. So I just got in here above these highs and just took it up when price really spiked up. Okay, and I took my profit at 65.37. Okay, no, sorry, I took my profit, sorry, at 64.32. So there we go. So 200 points, not bad. But that's what you do if you miss it, Abdul. Okay, so say there's another event, another Iranian strike, and you miss it. It feels sad to say, you've missed an Iranian strike, but sadly that's the business that we're in, and bad news can be a good trade, which is sad, but it's just worth marking that point. You can look at a retracement. So look at a retracement level. So a typical way to trade it is to trade at the 50% retracement and then take profit at the recent highs. So, the textbook way to have traded this would have been you draw your Fib retracement there, you trade to the 50% and then take profit at the recent highs. Not like here, because you may or may not go up to there, but like on these shoulders. So 63.67. So a textbook entry would have been 62.60 and taking profit at 63.70, something like that. Okay, that's the kind of thing that I would be expecting. I hope that helps, Abdul. Okay, and that gives you a little bit of that's what I'm looking at for the oil markets. And this is what I said. JP Morgan, they say the stress is bearable. UBS say crude prices may struggle from here, and Pantheon Macroeconomics see minimal impact on the US economy. So that's the vibe. That's the that's the mood out on the street. And you got to pay attention to this mood, and it makes sense to me because, as I said, no supply has actually been hit yet. Could change. Be aware. Okay, so key issue for the week ahead, I hope you're getting this, will be the escalation or the de-escalation of the US-Iran crisis. You can see how gold's been bid, see how oil's been bid, see how yen, Swiss franc have been bid. Whether this situation escalates or de-escalates is going to be key for the week ahead. So stay tuned into that, okay? And look particularly for any news regarding that, and look at response from the market. So now let's look at the scheduled events for the week. Now, there's not a whole lot going on this week. So let me just grab the calendar. Right, here we go. So far this week, it's been quite a light calendar here in the European session. And essentially, the main driver is risk sentiment. That's what the market's really focusing in on. We had some slightly weaker Chinese services PMI data out, but with the upcoming signing of the US-China phase 1 trade talks, the market is just sort of had pretty much priced in now the optimism about the US-China trade phase 1 talk deal being signed. I think it's the 16th of January. So a delegation from China is going over on the 13th. So I'm expecting the signing, I think, is on the 16th of January. Now that's fully priced in now. The market's not. I'm not expecting any risk on moves, particularly with that. We'll come to the US dollar side of that in a minute, but that's just noting that. We had a slight support in European PMIs, but there's nothing particularly to get overly optimistic or pleased about there. And we've got some low-level tier data, so I'm not expecting anything. All of today, just expecting that risk sentiment, US-Iran situation to dominate. Okay, Tuesday, the main event that I'm looking for is the ISM non-manufacturing PMI. This is essentially the services purchasing managers index out of the US. Now, if you look at the previous week, what you see is it was a light data week, as you'd expect for the holidays, but the manufacturing PMI data came out on Friday, and it was very, very weak, okay? That weak data was, I think that was the weakest reading. It was the weakest reading since June 2009. You can see here, okay? So very poor manufacturing ISM data, and new orders were down. So the new orders were the lowest since April 2009, and the headline was lowest since June 2009. So that is leading to a weak US dollar bias. So at the moment, the market has still got that big picture. It's weaker US dollar. In terms of like monetary policy, the Federal Reserve are expected by the market to ease further within the next 12 months. Now, the FOMC's recent dot plot showed that no board members are expecting any changes, but the market is expecting a further rate cut in the coming months. So this negative data point coming last week, the services PMI is going to be focused as well. Now, if the manufacturing PMI starts flowing over to the services PMI, and we get a weak reading here, let's have a look where we've been going. So say you can see the trend is down, but if you start getting a weak reading here, even down into contraction, then that will be further weakness for the US dollar. So looking at the calendar as a whole, the two US dollar events to look at for is the weak services PMI on Tuesday, and then the labor data on Friday. Okay, now labor data is generally regarded as a lagging indicator. In other words, it's one of the last data points to respond, okay, when an economy is in a slowdown. So it's expected that the employment data, the non-farm employment change, is expected to be down. You can see, look, these are some of the recent readings, pretty solid labor data for the US, but now expected 150. So the market's expecting to see some of this slowdown in manufacturing to start flowing through into employment data. So that means that if we get, say we get a weak, this is what I'm looking at, say you get a weak non-manufacturing PMI release here, and we get a weak employment data out here, then potentially we're looking at further US dollar weakness. Now, in contrast to the weak US dollar, we've had a more robust Canadian dollar, okay? So just looking at US dollar CAD, all right? You can see the US dollar CAD, you can see weak US dollar, stronger CAD. Now the CAD has been bought because, don't forget, CAD has a very strong correlation with oil. The US dollar Canadian dollar pair has a 96% negative correlation with oil. So in other words, when oil goes up, the US dollar Canadian dollar pair goes down. When oil goes down, the US dollar Canadian dollar pair goes up. So mark that, okay, that correlation. So if we see, the most obvious situation would be, say we get a weak US dollar situation, weak services PMI, weak labor data on Friday, and then we get sustained oil prices. Maybe there's another Iranian strike, or there's some supply issues with Iraq or Saudi Arabia, then we're likely to see more US dollar, Canadian dollar downsides. That would be my bias for that pair if those events happen. So that's one pair to look out for. The only slight spanner in the works is don't forget that the US dollar can be bid as a safe haven currency. Okay, just be aware of that. But given the correlation with oil, I wouldn't expect that to totally skew the pitch on that. So that's, a look at the US dollar outlook as well as the Canadian dollar. Now let's look at CAD in a little bit of detail. Where we've got bank. Now this is the speech. Always be aware for central banker speech. We've got the Bank of Canada Governor Ploutz speaking 7 p.m. GMT time on Thursday, January the 9th. Okay, so that is one to look out for. Now, the Bank of Canada was quite upbeat at their December meeting. They're sort of suggesting the economy is operating near capacity, wage growth has been up, consumer spending has been up, and the projection for global economic growth is intact. We have had now the US-China Phase 1 trade deal that's expected to be signed. So all that's sort of generally supportive of CAD. Furthermore, oil prices are being bid. So the general outlook for CAD is pretty good. But one thing to look out for is if the US-China Phase 1 trade deal doesn't get signed, or there's some negative problems there, watch out for that impacting CAD. Okay, so CAD is being influenced by those US-China trade talks, very much so at the moment. And again, labor data is important for the Canadian dollar. So watch out on the Friday. You've got two key releases, CAD release and the US dollar release. And watch out for comments from Bank of Canada Governor Ploutz. So one thing that would be worth looking at is if he takes a bullish shift. If he suddenly says, he might suddenly say, oh, we're looking at interest rate hikes. If he said something like that or indicated that the footing is going to be more hawkish, he has been more neutral at the moment. Neutral to bullish is arguable. But if he moves in a definite direction, then look out for CAD. And the risk for me is CAD buyers. So if Ploutz is optimistic and is upbeat, then look for CAD strength. And remember, one of the key principles is to pair a weak currency against a strong currency. So look out for that, coming up, okay, and be aware of that indication. Okay, now for the rest of the week, there's not a lot on. The only thing to be aware of is not only the US-Iran situation, but also the US-China situation. You can see there's a bit of a pattern here with President Trump, is he does like a argument, and there's potential flare-up with the US and the EU over imposing car tariffs on the EU. There's potential flare-up over US-China Phase 1 trade talks getting signed, and then on to negotiations for Phase 2. So watch out for Phase 2 negotiations. That is what will be moving the market really from now. So if you get any indication of Phase 2 going well, then expect more risk on sentiment. And of course, you have US and Iran. So there's three big US situations to keep aware of. Number one, US-Iran this week. Number two will be US-China that I'm expecting, with more focus on it probably next week. That is our look ahead. Don't forget, we've got the online trading workshop tomorrow. Gives you a chance to tell me what trades you're looking at, as well as looking at, the principle of pairing a strong currency with a weak currency. I'll go through some of the building blocks and tools that I use in my trading. I hope that's helpful, and I look forward to seeing some of you tomorrow, and I hope you enjoy your trading. Don't forget, be careful and be aware of changing risk sentiment. We're in a very risk sensitive market, and obviously the Iran-US situation is going to either escalate or de-escalate, but either way, be aware of some strong moves which may be happening this week, so be alert to that. Thank you very much for attending. I hope this has been helpful, and I look forward to seeing some of you tomorrow in the workshop. Take care now. Goodbye.